Hello, my name is Mike Kaufman. I'm with Clear Funds. I'm going to review some Phoenix Metro foreclosure market statistics. We've previously, in a previous recording, we talked about home sales per month and home sales per quarter. Now we're going to talk a little bit about sales price as we've moved through this market. What you see here today is the average price per square foot. These are sales prices by lenders and sales price by a retailer or a homeowner. What you can see here, and this is from 2011 October through 2012 September is still in progress. And really what you see is generally a trending of climbing price, not super aggressively, but nicely strengthening market. And you also see a reasonable gap between retail sale and lender sale. And in fact, the oddity of to some degree here is that the banking has caught up to retail sale, and in last month actually exceeded the retail sale price. What we'll see here when we look back a little bit farther, this goes back to fourth quarter of 2009. You'll see that the bank sale price was quite a bit different, quite a bit lower than the retail sale price. And if we went back even another year, you'd see that that gap was even greater. And then just as the market is cleaned up and there's less listings available in the market, I think it's brought up that bank price or that distressed property sale. So you can see that from 2009 Q4 up through last quarter 2012 that gap has closed between the pricing that the banks sell at versus the pricing that the homeowner or retail seller sells at. To talk a little bit about sales price over a longer look here. This is over a 10-year look, and part of the discussion here is where have we been and where do you think we'll go. Starting back here on the far left, we're at 2001 third quarter, and then over here on the right we're Q2 of 2012. So here we were progressing along, and I'll tell you, this curve that we see here from 2001 to 2004, if you drew that back for 10 or 20 years, it really is this kind of low slope. And then obviously we all know the story of the ramp up in demand and ramp up in price and the flurry that we went through here. This is what we're looking at here as we climb. This is 2004, 2005, obviously very steep climb, and then 2006, 2007, and then boom, we start the decline, 2008, and here we are 2009, 10, 11, 12. So if you took the historical appreciation rate and you drew a line across here like this, we definitely have some pent-up value here, unclaimed value. So where does that go? And I don't know. I really don't think we're going to have a steep climb to get back up on that norm. But we will have to appreciate faster than the historical, obviously, to get back up on that line. So is that a 5-year line or a 10-year line or a 20-year line or a couple year? I mean, everybody has different opinions. I mean, some people are buying, perhaps paying a little too much for properties today in anticipation that there will be some stratospheric appreciation. Personally, I'd prefer a more gradual historical climb. Here you can see between Q1 and Q2 we really did have a steep climb. I mean, that is nearly as steep as you see over here in 2005 Q1. So I don't know where we're headed. The market is fairly healthy. There is low supply, very low supply, sub 150,000. The higher ends, the high ends, lots of supply, still trading at a pretty significant discount, I think. But anyway, we kind of project, we're doing short-term lending. We're doing 6-month notes with a 6-month extension. So we're not trying to bet too far out on what we will or won't see. We're currently projecting a pretty flat valuation. We do all of our own evaluations here in-house, and we sometimes give a little bump of appreciation as we look forward in that 6 months, depending on what's been going on in a particular zip code. Today we're really holding flat. We're just using what the comps are today. We're saying that's what the value is, and lending based on that criteria. I'm going to talk a little bit about home sales per month. What this chart shows you is Maricopa County lender sales versus homeowner sales, and you can see it's predominantly homeowner sales or retail sales, which historically the last few years was not the case. The banks were the predominant sellers in the market. So this shows strengthening in the market. Month over month you can see more retail sales than bank sales, and you can see the bank sales trailing off. A little bit of a blip there. Rumor mill was that the banks were going to push a little harder on liquidation of assets or more aggressively foreclosing on stuff that they'd let slide for many months. I mean, there has been some houses that have been foreclosed on that have been pending for 1 and 2 years, and then I'm sure there's people that have been delinquent for 1 and 2 years that have not even been noticed yet. So I think that the trend will be that the banks will continue to push properties through. But anyway, this is regarding home sales. So these are properties that the banks took back and then they sold. That's the 1,033 you see last month versus 3,600 retail sales. Our clients typically are buying distressed property either from a bank or at the trustee sale, fixing it up, and then they're selling retail. So that's kind of what you see here. Another reason that this has dropped off over time is, and if we look back farther, you would see that this would be sliding down month over month, but one of the reasons is not necessarily that there's less distressed property, but the banks got much more in line with the idea of the short sale back in very late 2010, early 2011. So that was just a different point of liquidation that they finally figured out was a more efficient way to liquidate property. The other chart here is the same data, home sales, bank versus retail. It's just a quarterly look, so we can look back a little farther to illustrate some of those things I mentioned. And you can look back here in 2009, see the banks were predominantly the sellers of property, and then that's just dropped off as we progress through this stuff, and then the retail sales have picked up. Nothing earth-shattering there, but it does suggest a healthier market and a declining distressed market. I'd like to talk a little bit about trustee sale filings per month. This is the quantity of filings. So somebody's gone into default, the bank has filed a notice, and then they can take that notice to sale within 90 days. Many of these go pending. Pending means the bank just lets it go. They don't actually send it to the trustee sale. Why they do that? There may be a short sale pending. They may have chosen to just not resolve that particular issue at that time, or maybe they just haven't gotten to it. I'm not sure. But so these are notices per month. So someone went into default and received a notice from the bank. And the main message here is that you can see this is declining month over month. It's nothing earth-shattering. Things are improving. There doesn't seem to be any hint of the so-called shadow inventory. We've heard about that for years now. We did hear the urban legend was that the banks were actually starting to notice more people, because we all know there are some people that have been living in their home in a default situation and have not been noticed. So I think there are some troubled assets out there that are not being liquidated or not going to trustee sale or not being short sold. but I just don't think it's of a scale that will move the market. So I think we may see some blips where maybe a particular month or quarter gets a little heavier than it was the month prior, but I don't think we're going to see numbers like we saw back here in 2009, where I mean there's 5, 6, 7,000 people a month being noticed. Now today you can see we're kind of 2, 3,000 people per month. And then here's the same statistic, notices per year. Really the main thing to see here is give you an idea of scale. This is 2001, 2, 3, 4. So here we are, we're 15,000, 14, 9, 11, everything's great, and then boom, bad things start to happen. So we're 29,000 in 2007, 78,000 in 2008, and over 100,000 in 2009, and then we start cleaning house. And 2010 we end up at 80,000, and then 2011 62,000, and 2012 to date we're at 35,000. So we are moving through this. Things are getting cleaned up. I suspect that we're going to see numbers similar to this year. I don't think we're going to see this steep of a decline. My prediction is we're going to see sort of a flattening, and then we have 2 to 3 years of kind of plunking through some of this distressed stuff before we start getting down into these more normalized numbers. The next review we'll talk about trustee sale third-party purchases. Thank you.